Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Welcome to the webinar. I'm Melanie Audette of Mission Investors Exchange, a national network of foundations and philanthropic asset owners that use or are learning to use mission investing as a strategy to accomplish their philanthropic goals. We're based out of Philanthropy Northwest offices in Seattle. As the co-host organization along with Moss Adams LLP, we are pleased to welcome an outstanding showing of over 190 people registered online with us today. Fair warning to those viewing that this webinar is intended to dig deep into the weeds on issues of accounting and tax treatment of mission-related investments and PRI'S. We will be looking together at tax forms, and our speakers will discuss mission investing in some financial detail in this technical webinar. Our webinar is 50 minutes long with 10 minutes for questions and answers. If we do not answer your questions today, we will follow up with you to answer them after the webinar. Our contact information is at the end of the slide deck. This webinar offers continuing professional education credits thanks to our partners at Moss Adams. In order to receive the credit, you must listen to the webinar and answer the 4 polling questions throughout. I'm going to begin with introductions of our speakers, then we'll ask the 2 poll questions for the audience. We'll then have a quick overview to ensure that we're on the same page with definitions, and then we'll begin to explore more fully the tax and accounting treatment of various types of impact investments. We'll begin with introductions. We have with us today Sayre Jones, the Director of Finance and Mission-Related Investing at Meyer Memorial Trust. Sayre Jones works on program-related investments and other mission investments held by the Trust. Previous to joining it, he worked in the nonprofit practice at Moss Adams LLP in Portland, was the business manager for a software company, founded a student-run radio station, and spent a year working at a Portland-based low-income housing provider. We also have with us Wendy Campos, partner at Moss Adams LLP. Wendy's been in public accounting since 2000 and serves as a tax leader of the firm's not-for-profit industry group. She focuses primarily on providing tax compliance and consulting on issues such as unrelated business taxable income, obtaining and maintaining tax-exempt status, self-dealing, Forms 990, 990-PF, and 990-T, CA-10A, compensation reporting and distribution grant-making planning. Her current focus is serving hospitals, higher education institutions, foundations, both public and private, social service organizations, and other not-for-profit organizations. She is currently a member of the Oregon Society of CPAs, Philanthropy Northwest, and the American Institute of CPAs. Before we share our learning objectives, we would like to know a bit about our audience. We're going to open up the poll question, and especially for those applying for CPE credits, please answer these poll questions. For this question number 1, please tell us what your role is at your foundation. CEO or Executive Director, CFO, Treasurer, Controller or Accounting, Investment, Program Staff, Foundation Trustee, or Other. We'll leave the poll open for about 30 seconds. And again, if you're applying for CPE credits, please make sure that you complete the poll. In a moment, we'll be moving on to our second poll question. I'm going to go ahead and close out the first poll question now. Looks like Controller and Accounting has 22.8%. CFO 22.8%. I'm opening the second poll question now, and if you could make sure to answer this one as well, especially if you're applying for CPE credit. This is about the type of foundation you represent. Do you represent a private foundation, a community foundation or public charity, a corporate giving program or corporate foundation, or something else, other? We'll leave the poll question open for a few more seconds so that you can answer this. I'm going to go ahead and close this poll question. Let's see the results. Looks like we have an even split between private foundations and community foundations, public charities. Now we'll move on to our learning objectives. Today our hope is to build a basic knowledge of the terms and structure of program-related investments and corpus investing that has social or environmental impact. We'll understand the effects of various types of foundation mission investments on the balance sheet, income statement, and tax statement. Get a beginning understanding of the application of unrelated business income tax in certain circumstances related to impact investing. Receive in-depth technical information and an opportunity to ask questions of tax and accounting foundation professionals. Learn how other foundation finance officers have successfully worked cross-team between finance and program to carefully document and measure social, environmental, and financial goals, and identify resources for continued learning. Let's make sure that we're on the same page with definitions. What is mission investing? Mission investments include any type of investment that is intended and designed to generate both a measurable social or environmental benefit and a financial return. Although we hear about impact investments, mission-driven investments, and other terms, the IRS has given us guidance in this area only on program-related investments, or PRI'S, for private foundations in the code at Section 4944C. The terms impact investing, mission-related investing, mission-driven investing are not defined by the IRS, but are, of course, defined by foundations for their particular purposes. As a refresher to many of you, private foundations are required to pay out annually 5% of their assets for charitable purposes and administrative purposes related to the charitable purposes. The 95% left over after that is referred to as the corpus in this presentation. Historically, for most foundations, the 5% has been for grants and the 95% has been for traditional investments, until we come to mission investing. This is about going beyond grants and traditional investments to activate more of the foundation's assets for mission. And I'll turn this over first to Wendy Campos to provide us with further detail.
Great. Thank you, Melanie, for such a great introduction. Melanie gave us an intro into what mission investing is and some common terms, but I wanted to give some further insight into the term corpus investments, which she also has introduced us to. Really, we're talking about the investments out of that corpus, that 95%, if you will, that doesn't have to be distributed by a private foundation. These are investments. They're typically not charitable in nature, so we're going to talk about program-related investments here in a few minutes, and those are more charitable in nature. But when we talk about corpus investments, usually it's again, your investment portfolio for an investment purpose. Typical investments, stocks, bonds, mutual funds, money markets, alternative investments, which we will talk more about when we talk about unrelated business income, but that just kind of gives you a flavor, some examples when we're talking about corpus investments. It's really just another term, but wanted to, again, give you additional insight there on what we're talking about. Program-related investments, and we're going to refer to these as PRI'S throughout the presentation and in your handout materials. PRI'S are investments that possess three different characteristics, and it's really a three-part test, so a PRI would need to possess all three of these characteristics. Its primary purpose is to accomplish charitable, educational, or other similar purposes, so it's within the foundation's exempt purpose. The production of income or any capital appreciation cannot be a significant purpose for making the investment. And the program-related investment cannot be made to influence legislation or campaign on behalf of a candidate for public office. So those of you that are private foundations, you're probably very familiar with PRI'S, and if you're not or not into them, you are at least familiar with the content of these three tests. Typically, a private foundation can't engage in lobbying and political activities, that type of thing. I want to talk a little bit further about the primary exempt purpose and the charitable purpose of a PRI. In terms of the regulations, the PRI should be set up and established to organize and operate exclusively for religious, charitable, scientific, or educational purposes. And again, your private foundation is already going to have an exempt purpose, so it's going to fit within that in some form or fashion. It could also foster national or international amateur sports competition. Again, if that's not within your mission, though, obviously your PRI would probably not stray too much from your mission as well. And then it needs to significantly further the accomplishments of your private foundation's exempt activities. And the investment would not have been made but for the relationship between the investment and the accomplishment of the exempt activities. So that ties back into the primary purpose for entering into the investment cannot be financial gain, if you will. Now, that could be incidental for the accomplishment of the exempt purpose to be successful, but it can't be the primary reason for entering into that investment. Another unique aspect of a PRI compared to just your typical corpus investments is with PRIs, there's always going to be some sort of a PRI agreement. And the tax regulations by the IRS are pretty specific in terms of what needs to be in that agreement. You need to put the purpose of the investment. And again, that's going to tie to the charitable purpose. The agreement needs to state the restriction on the use of the proceeds. So this goes back to no lobbying or political activities. The requirement to repay any funds that are not used for the specified purposes. So if you're entering into a PRI, let's say it's a loan PRI, which are usually the most common that we see with another organization, there needs to be content in that agreement that both parties are signing that the private foundation has the ability to ask for repayment of the funds if they're not used for the charitable purposes that they were intended. And then there can be special equity rights. So if there's a loan situation with some repayment terms, there can be, sometimes we'll see maybe after a few years there's an equity option to where the private foundation could actually gain equity into a company and not just a receivable or loan situation. Sometimes we see just equity PRIs as well, where there's not a loan component. So there's a little bit of flexibility there in the way the PRI is structured. But key is to remember there's always going to be some sort of an agreement with pretty standard language around the PRI regulations of the IRS, which is very different than just corpus investing. All right, we're on to our third polling question. A program-related investment has which of the following characteristics? Charitable purpose, not used for lobbying, it is concessionary in some way, usually expectations of timely and or high rates of return. It is patient and may take longer than a typical investment to make a return, or all of the above. So we'll give about 20 or 30 seconds to give everyone time to answer those questions so you can obtain that CPE credit. All right, we'll go ahead and close the polls and take a look at the responses. Oh, good. So almost 84% of you. All of the above is the correct answer. Again, the primary is charitable purpose, so I see about 12% answered that, which is correct, but it also cannot be used for lobbying. And we didn't talk specifically about the next two options, but usually there is some sort of expectation in terms of returns. And when we talk about being patient and may take longer than a typical investment, again, its primary reason is for charitable purposes, not necessarily the financial gain. So good. Most of you got that answer correct, and the rest of you are on the right track. All right, I'm going to go ahead and turn it over to Sayer.
Hello, this is Sayer from the Meyer Memorial Trust. Thanks everyone for attending this session. It's nice to see so many people who are from the financial side, so that's where I've always worked. Be interested in mission-related investing and program-related investing. So I wanted to do a little sidebar piece that honestly, when I started in this field about 7 years ago, I went to the PRI Makers Conference down in New Orleans, and I had many miscommunications with people about how PRIs affect payout. And so I went back and tried to figure out why that was the case, and it took me some time. But I figured out that the miscommunication comes from the fact that not all foundations are the same, which, not being from this field before, it should have been, it's obvious now, but it wasn't obvious back then. So we have community foundations that PRIs are not really relevant to. I'm unsure whether or not corporate foundations, they're relevant or not there. But as far as the private foundations go, there's really two different, I need to speak a little bit louder. When it comes to private foundations, there's two different things that come up that actually drive the one conversation, which was 7 years ago I heard people say, you don't want to do PRIs because as soon as a PRI is repaid, you have to pay that money right back out again. And I didn't quite understand what that meant because it wasn't relevant to us, but I figured it out, and so I thought I'd go through a little exercise that looked at some tax returns to explain where that concept came from and how we might be able to address it as foundation officers. So let me advance to the next slide here. So here is tax return. This is page 9, the part 13 of a tax return. So this is live data, but we took out the names and EINs. In this foundation's case, if you look at the top line, which is line number 1, this number is current year payout. So the amount of money that actually needs to be distributed in the current year per calculation. What the difference between this and the next one I'll show you is column C that says 2012 here has a 0 in it. So theoretically, this foundation doesn't have to pay any money out in the current year because because as soon as numbers start populating in column C, those are the numbers that actually dictate what you have to pay out in order to avoid the significant 30% excise tax for undistributed income. So in the case of this foundation, a repaid PRI would increase this line 1 number, so it might go from 44 up to 48 if you had $4 million in repaid PRIs. which would change your current year amount that you have to pay out, but it doesn't mean that you'd have to pay an additional $4 million out in the current year. You'd actually have to deal with that in the following year. So let me advance a couple slides here to another example. So this is off of GuideStar, so that's why it's a little bit wonky. The scanners there sometimes don't pick up stuff like you'd like it. So here's a second example. As you can see in this example, there's a large amount sitting in column C under 2012. And so this foundation has, under qualifying distributions, line 4, you'll see a number that closely approximates what's in column C. So this foundation is optimizing, is using this calculation to actually drive their payout decisions rather than the former foundation, which is doing something else. Maybe they're optimizing tax, the 1 or 2% tax rate. So in this foundation, the conversation would be different because the $35 million that you see on line 1, if you had $4 million repaid in the current year, that number would be $39 million. That number would get pulled over to column C on next year's tax return, and your conversations would be about having to pay out $39 million worth of taxes versus 35. So in this case, the answer to the question of PRI'S having to be repaid in the current year is sort of. Actually, you'd have to address it next year, but you would have to address it dollar for dollar. So the third one I'm going to show is actually our tax return, and you can see we're sort of in between, where we do have a dollar amount sitting in column C, but our average payout is about $35 million. So the $1 million that we had to catch up for 2011 is insignificant, but it would. So anyway, the purpose of this whole exercise is to think about how a repaid PRI might affect your net payout, and if you are the type of foundation that carries a large balance in column C, it might be worth trying to model repaid PRIs into your current year payout projections. If you're a foundation like the First Foundation or like us, it isn't really a factor that much. Repaid PRIs can come in pretty much at any time, and it won't drive our decisions to any great extent. So that's all I have to say about that one. I kind of think it's an interesting intellectual exercise, and it helped me in communications. I'll hand it over to Wendy next to go into the next few slides.
Thank you, Sayre. That's a great segue into my next probably 5 to 10 slides. And I will preface this section. I'm going to talk about the accounting implications of PRIs versus corpus investing, as well as the tax implications. And I know that we've got quite a few community foundations and public charity foundations on the webcast today, and I want to make sure that I preface this with the discussion on the accounting implications, for the most part, for a private foundation versus a public charity foundation or community foundation, for example. The treatment's the same, so you will get something out of this portion of the presentation. But when I talk about the tax implications, those are pretty specific to private foundations. So I don't want to alarm anybody that there might be an excise tax out there, for example, that they haven't been paying that they might be subject to. That's very private foundation specific. The one area of tax that I will touch on that does apply to any type of organization on the line is when we talk about unrelated business income. So make sure that if you tune out for 5 to 7 minutes in this next part of the presentation, that you pipe back up and pay attention to the unrelated business income tax portion, because that does apply to all organizations that are on the line today. So you also have, I want to make sure I mention, we have some handouts in the webcast console. There's a file folder looking icon, and we've got a couple of handouts in there that I'll be referring to as I go through these next set of slides. One is a table that compares the accounting implications and tax implications of a PRI versus corpus investing, and the other is the blank 2014 Form 990 PF that I will be referring to. I will have print screens the slides are going to have all of this information on them, but it might be helpful. Some of you might find it more helpful to actually have the handouts in front of you, or maybe you printed them out in advance. And they'll be available, I believe, for download even after the presentation has ended, as well as the slides. But again, just wanted to let you know I will be referring to those throughout this next set of slides. All right, so in terms of accounting implications, on the balance sheet, a PRI, if it's a loan, it's going to be an asset on the balance sheet. And it might be called a program-related investment. It might be on its own line on the balance sheet, on your financial statements or on your tax return. Or it could be a note receivable. And we'll talk about the lines on the tax return. And again, I'll have print screens of those as well so you can see the visual after we go through the table and comparisons here. A corpus investment is, if there's a loan, it's going to be an asset called note receivable. If it's equity, it's going to be on the other investment line. An equity PRI, again, could just be called a program-related investment, and it's on its own line. And it's possible on your financial statements, program-related investment could include both equity investments and PRIs that are set up as loans. That is possible. Same thing with the tax return. They could end up all on one line, depending on your preference. Some private foundations prefer to list them all, each PRI out separately if they don't have a bunch of them, but it really just depends. Or they could be on the other investment line, again, if they're an equity investment PRI. In terms of the minimum distribution requirement, again, this is a tax concept for private foundations only. For PRIs, the minimum distribution requirement is credited as though a grant were made. So it's the same thing as making a grant in that year. So the payment of the PRI does help meet your minimum distribution requirement. If it's a corpus investment, there's no effect on the minimum distribution requirement because, again, we're talking about investment assets and not charitable assets. Minimum distribution requirement is a charitable expenditure concept, if you will. In terms of the 990 PF and the lines where you'll see some of this, just in case you want to follow along with the table, on page 2 is the balance sheet of the 990 PF for 2014. Line 7 would be where you'd see a loan receivable, or line 15 would be an other asset, if you will, if you're listing it as a program-related investment and not as a loan receivable. All right, so if you've made a PRI and it's set up as a loan receivable, you've got that on your balance sheet in your loan receivable or other asset category. As it's being repaid and principal payments are made back to the foundation, the asset's going to decrease on your balance sheet. You're going to have a component of principal that's going to affect your minimum distribution requirement. And Thayer has already alluded to this when he was showing you some examples of the minimum distribution requirement on page 9 of the form for a few different private foundations. But that will have the opposite impact as it did when the PRI was made from the foundation. So when it comes back in, it affects that minimum distribution requirement. If it's a corpus investment, there's no effect, again, because there wasn't an effect when you made the corpus investment. The interest component, if it's set up as a loan, is going to be recorded as interest income, whether it's a corpus investment or a PRI. And usually you'd see maybe dividends, interest. There could be maybe some unrealized gains, losses on a PRI. Not as common with a PRI, but definitely with your corpus investments, there's usually some sort of realized gains, losses. And keep in mind, as we go on to the next slide, we'll talk about the excise tax for private foundations because those will be impacted by this income that you're recording. But from a book perspective, accounting implication, you're going to see this in your revenue section as interest income, dividends, if that's applicable, or realized or unrealized gains and losses. All right, the interest income, as I alluded to, is taxable for a private foundation, whether it's from a PRI or from a corpus investment, and that's at the 1 to 2% federal excise tax rate, depending on what rate you're in. We're going to talk about unrelated business income here in a minute, so I'm going to table that next comment on the top of the table because I do want to mention that on the previous slide, we talked about realized and unrealized gains, and I don't have this on the table, but I want to make sure that everyone's aware. Unrealized gains are not income on the tax return for a private foundation, a public charity foundation, community foundation, or any type of tax-exempt organization. Those are a reconciling item and are not revenue. They might be revenue on your audited financial statements, and usually are, but they would not be revenue for purposes of tax, whether that means being subject to the net investment income tax or just in your revenue in general. They are not subject to being reported as revenue on your return. So I wanted to make sure and mention that because we didn't have that in the table. All right, so let's talk about unrelated business income a little bit. Income from PRIs, typically, if you've got your loan receivables, you've made a loan to another organization, is just going to be interest income coming in. It's not going to be unrelated business income because the whole purpose of a PRI is a charitable purpose, so it's within your mission, so it's a related activity. The interest income is going to be subject to the excise tax, which we already talked about. The other piece of it is we also talked earlier when we defined PRIs about the fact that the primary purpose for entering into it can't be financial gain. So oftentimes, not always, because there can be some incidental gains that come out of a PRI agreement or relationship, if you will. But most of the time, there's maybe not a profit being net, so it technically probably wouldn't even meet the definition of a trade or business when you look at the regulations and the rules around unrelated business income in the tax-exempt world. So areas where we usually do see unrelated business income come up are actually more often in the corpus investing world, and most specifically the alternative investments, which typically are your partnership investments where you're getting a Schedule K-1. So I wanted to talk a little bit about the most common unrelated business income areas we see around PRIs or corpus investing. Partnership interest, if you get a K-1 from any sort of a partnership interest that you're in, and it's got income or a loss on line 1, which is the ordinary income line, that really needs to be looked at further if the tax preparer of that partnership return hasn't done an analysis and disclosed your unrelated business income. Because typically, that means an ordinary trade or business is being run within that partnership. There's not just interest income and dividend income and realized gains being generated. There's actually a business being run. So there has to be a determination on whether that business is related to your foundation's exempt purpose. More often than not, that answer is usually no when we're talking about the investment side of what foundations usually do. So again, if you take one thing out of this presentation in terms of the unrelated business income section, if you see an amount on line 1 on a K-1 where the foundation is an investor, and there's no information provided on whether that's unrelated or what it is, you need to inquire further. Don't just assume it's not unrelated business income because nothing's disclosed as such. You do need to look into that a little further. So that's one of the most common areas where you're going to see unrelated business income in the investment side. And again, that's usually with the alternative investments. Another area that's very common that we see is debt-financed real property or debt-financed securities. So that also can fall within partnership investments, but it also could be foundations that have real property and they're renting out that real property and they have debt on that property. Unrelated business income can easily get triggered in that scenario. We don't see this as much, but still is possible where either within a partnership investment that the foundation has invested in or within the organization, you've borrowed to purchase securities, and then you're doing your securities on margin because you're getting a higher rate of return by doing it that way. That also can trigger some unrelated business income. So keep that in mind as well. Those are 3 common areas where we see unrelated business income pop up in this specific technical area that we're talking about today. For private foundations, if you've got an investment that's generating unrelated business income and you've got to report that on the 990T and pay either the corporate income tax rate or the trust income tax rate, however you're structured and set up, then keep in mind, and we see this missed more often than not, that you don't also have to pay the excise tax on that, the net investment income tax, the 1 or 2%. If you have to pay unrelated business income tax or include it on a 980T, then you don't also have to included as net investment income. And I'll show you what I'm talking about when we actually refer to the forms here in a few minutes. And then the other thing I wanted to mention in the unrelated business income area, which is definitely outside of the context of our presentation today, but it's worth mentioning, if you are into alternative investments, be aware that a lot of times these partnerships come with other state filing obligations, or at least an analysis needs to be done on whether you've got other state filings that need to be done outside of your home state, as well as foreign disclosure type filings. And there are pretty high penalties for not filing those foreign disclosure forms, even though they are just informational and involve no tax whatsoever. So just keep that in mind if you are a foundation that's new into alternative investments, or you're thinking about them and just aren't quite familiar enough with those requirements. All right, on that same slide, before we move on to the next slide, if a PRI is determined to be a loss or worthless debt, it could be recorded as bad debt expense in terms of the accounting implications, or as a decrease in the balance sheet, maybe the allowance account against the receivables. And this will be on your 990 PF page 2, line 7, which is the allowance for doubtful accounts. It would be in the expense section if a bad debt expense. And the asset would also disappear from the balance sheet. And this applies for both a PRI and a corpus investment. And when we talk about the tax implications, the minimum distribution requirement would not be affected because the amount's already credited when the investment was made. And for a corpus investment, again, we've learned that the minimum distribution requirement is not directly affected by corpus investing whatsoever. All right, so I do want to go through and summarize a couple things I already talked about on the federal tax implications, but also mention some others and compare PRIs to corpus investing. So we've talked about the investment income tax, and I've given you some code sections just as reference. I know probably a lot of people on the line are not those that like code sections thrown around a lot, but again, it's just for your reference for future if you need to look anything up or inquire further. The investment income tax is under Section 4940. So both a PRI and a corpus investment, any income earned from those investments is subject to the investment income tax. Self-dealing under Section 4941, that applies to a PRI and to corpus investing. And we'll talk we're going to touch just a little bit on that, not go into grave detail, but again, I want you to have a reference to refer back to. Taxable expenditures, and I refer to ER here, that stands for expenditure responsibility. That's under Section 4945. That only applies in the PRI scenario, not corpus investing. And I am going to talk about what expenditure responsibility is at a pretty high level here in a few minutes. Unrelated business income tax, we just talked about that. That could apply to a PRI or corpus investing. The excess business holdings under Section 4943, that would only apply or could only apply in the corpus investing world, not PRIs. And same with the jeopardizing investments under Section 4944. That applies in the corpus investing world, but not PRIs. So in terms of self-dealing, a common self-dealing concern that we are faced with our client base, or that we're often asking about, and this would apply for both PRIs and corpus investing, is when a foundation, private foundation, and a disqualified person are co-investing, if you will, in a company or investment fund, or otherwise mutually participating in investment opportunities. So they have investments in the same alternative investments or partnership investments, if you will. That's where you've got to be real careful about the self-dealing. And the consequences to both the foundation and the disqualified person can be severe. So again, a good reminder that it's not just the foundation we're talking about here. Most of the time with a lot of these excise taxes, it's the foundation manager, foundation board member, disqualified person, if you will. And really the issue there is whether the co-investment constitutes the use of the private foundation's assets for the benefit of a disqualified person. And the IRS has a number of rulings on co-investing and identifying various ways in which foundations could impermissibly benefit disqualified persons. So some of the examples in the rulings are resulting in lower fees for the disqualified person, smaller minimum investment amounts because the foundation's also investing, or greater access to investments. Those are just some examples. All right, I mentioned expenditure responsibility, and I have a quick slide here just to define it in case there are some on the line that aren't familiar with expenditure responsibility. And again, this tends to be specific to private foundations, but we do have some community foundation clients, and it has come up with a couple public charity foundation clients that have entered into maybe grant agreements or are doing program-related investments that require some expenditure responsibility. So the disclosure on the form isn't going to look like what I'm going to refer to on the 990PF for those on the line that have that situation, but you would still go through the same processes, if you will, in terms of before making a PRI that requires expenditure responsibility, you would do certain level of due diligence that's above and beyond what you would for other grant recipients or PRI recipients. And basically what the regulations say is that the foundation should conduct an inquiry or due diligence review of the PRI recipient sufficient to give reasonable assurance that the recipient will use the funds for the proper purposes. And they give some examples. The inquiry should cover the identity of the organization, the prior history and experience that you may have with that recipient and its managers, the management activities and practices of those organizations. And the regulations give some more specific guidance, and I haven't put those on the slide, but that's under 4945, which was referenced on the slide previous in terms of expenditure responsibility. And I've got the next slide to talk about the tax, which I'll go through pretty quickly, but then the following slide gives you some examples of when expenditure responsibility might be required. So expenditure responsibility, if it's not exercised on a PRI where it should have been, then there's a tax that's due. Typically the tax would be, I've only got the secondary tax mentioned on this slide, I apologize for that, but you're basically looking at the value of the taxable expenditure is equal to the value of the PRI that you paid out in that year where you didn't exercise expenditure responsibility and should have. And then the tax is paid on that amount. So what types of PRI recipients does expenditure responsibility apply to? And I realize that this list is pretty long. PRIs tend to be more, we tend to see a few little buckets that they come out of, but I wanted to make sure you had a reference that's more all-inclusive. If you give PRIs to your typical public charities, U.S. and foreign governmental units, exempt operating foundations, or executive orders, you're following the same requirements you would if you were giving a grant to those organizations, and you would not have to exercise expenditure responsibility. And same goes for those where you do have to exercise expenditure responsibility. U.S. exempt organizations that are not public charities, so your C6s, your C4s, private foundations, certain supporting organizations, newly formed public charities that don't have their IRS determination letter yet, for-profit entities, which that's actually a very common form of PRI is for-profit entities, and then foreign organizations for which no equivalency affidavit or determination letter has been obtained. So this, again, gives you a reference of when you may have a PRI where you've got to exercise expenditure responsibility. All right, so I want to go through the forms real quick before we close our presentation and then get into some Q&A. I've referred to these line numbers, and again, you've got the forms in front of you, but I just wanted to kind of give you the visual. When we're talking about the investment, net investment income tax, obviously we're talking about lines 3 and 4, and then on to the next slide, line 7. Those are the most common, the capital gains, interest, and dividends. The other areas I wanted to point out, though, is I did mention situations where you could have property, real property within your foundation. So you might be renting that property out. So you could have some gross rents on line 5 that would be subject to the net investment income tax or could be subject to the unrelated business income tax. And then for those that are heavily invested into alternative investments, line 11, other income, you tend to see a lot of income ending up on that line in terms of the 990PF. But oftentimes you may see most of it in column A and only some of it in column B, and that's because you probably have some that's unrelated business income that's got to be reported on the 990T. All right, I skipped through one slide. It really just was the bottom of that page and not necessarily relevant for what I wanted to highlight today. Here, Part 7B, this is page 5 of the 990PF. Really what I wanted to just point out here is these are your trigger questions that you would want to consider if you're entering into an investment that maybe disqualified persons are entered into in terms of the self-dealing, so just be careful and aware of those. This is the continuation of page 5. These are where you'll find questions. Sayer talked about not meeting your minimum distribution requirement, having undistributed income. That's where line 2 comes in. I mentioned the excess business holdings, that's line 3, and then I mentioned jeopardizing investments, which is line 4. And then in terms of expenditure responsibility, this is where page 6 of 980PF is where you may have a trigger question that's then going to tell you need to attach a statement, because the other requirement with expenditure responsibility is that you've got to report back to the IRS on what reports did you obtain from that recipient, that PRI recipient annually, how are they spending the funds, etc. So you may have an answer to line 5A4, for example, that you provided a grant. Now in this case it's a PRI to a organization that's other than charitable. So maybe it's a taxable organization. But if you exercise expenditure responsibility, you meet the exception on line 5B, but you do still have to attach a statement. So again, just trying to give you some information to refer to. We'll skip over a couple of these that aren't as relevant. The continuation of page 7, all I wanted to just highlight here is part 9B, the summary of program-related investments. If you are doing PRIs, you're going to give a description of your top 3, and the amount is going to be the amount that you paid out that year. So you may have a PRI from the prior year that still has an amount on the balance sheet. The principal payments are being made, but you gave them an additional loan of $100,000, for example. The amount you disclose here is that $100,000 and not the previous amount that you disclosed on last year's return. And then one page that was pretty critical that I neglected to include in the presentation, which I apologize for that, is page 8, parts 11 and 12. And I did just want to mention two key line items because we've talked about them a lot in the table of the tax implications of PRIs specifically. Line 4 in part 11 is the principal repayments from a PRI. So we talked about how that can then increase your minimum distribution requirement. That's where you're going to see that line. That line's going to come into play to go into that calculation with your tax return. And then line 2 in part 12, if a PRI is then being paid back, or in the year the payment is made, so it's a PRI you're making out that year, that's how it goes towards your minimum distribution requirement and lowers that requirement, and that's line 2 in part 12. So again, I apologize those aren't on the slides, but you do have the handouts to refer to. All right, so we've got one more, our last polling question. True or false, a program-related investment can trigger the excise tax on jeopardizing investments. And we'll give about 20 seconds or so before we close the polls. All right. All right, so we've got about 66% that said that's true and 34% that said false. And that is actually false. PRI is not subject to the jeopardizing investments regulations under Section 4944. Only a corpus type investment would be subject to the jeopardizing investments. Because again, remember, this is charitable in nature when it's a PRI. All right, I'm going to turn this over to Sayer or Melanie so that we've got some dashboards. We're going to try to maybe get through that real quick if we have time, but we want to make sure and leave plenty of time for Q&A as well.
Hi, this is Sayer. I think given how dense the work is so far, we're just going to skip over the piece about dashboards, and we wanted to open it up for some Q&A. There will be an opportunity for everybody to fill out a poll, and we would like to figure out some of these topics. If there's something that we would people want more detail on, It would be nice to get some of that feedback so that we can start developing more of these technical webinars. This one was just trying to reach the gamut. I know we covered a lot of material. I think Wendy did an excellent job.
Okay, so we're going to go to the first question, and I encourage others to go ahead and add your questions for us. We have three here to start with. And so I'll go ahead and read the first one. It says, we do not take PRIs as a qualifying distribution at their onset. Please confirm whether we might subsequently take a qualifying distribution if we need to write off the PRI for non-payment of principal.
Yes, this is Wendy. Good question. And I may defer this to follow up with you directly after the call, but you know, kind of general, high level, without all of the factual information. You know, if you haven't, the technical answer would be you probably should go back, amend returns, and properly include it in your minimum distribution calculation. That's the technical answer for open years. If the amounts go so far back that they're closed years, I would off the cuff say that neither option is available. You definitely can't go back and amend, but I probably wouldn't encourage you to include them at the point of bad debt. But again, you know, I think I'd maybe want to follow up more directly after the call with all the facts.
Okay, let's move on to the next question. What would be the tax implications if the return on an equity PRI exceeded the market rate of return? That's an equity PRI. What is the standard capital gain rate?
Sorry, I'm just reading back through it, Melanie. I listened while you were talking, but just want to read back through it
I'm
again.
going to repeat that.
Yeah.
What would be the tax implications if the return on an equity PRI exceeded the market rate of return?
Well, so if you're a private foundation, you know, you're paying the tax at the excise, the 1 or 2%. So the standard capital gain rate is not applicable. If we're talking about an unrelated business income situation, which I'm assuming we're not, then your capital gain rates depend on whether you're set up as a trust or a corporation. For corporations, there really is no difference in terms of capital gain rates. For trusts, it follows very much like individuals do. But if I'm following right, I think you're just going to be subject to the net investment income tax on that excess, which is just the 1 or 2%. So the capital gain rate's not going to be applicable in that scenario.
Hey, Wendy,
Okay,
can I tease a little bit out on that one?
Yes, sure.
So what if it was determined in this case that your investment in this company was maybe not for charitable purposes? What would happen then?
After you've already gotten into the investment, then it's determined at a later date?
Sure.
So it's determined that it's, for some reason, it really wasn't a PRI, for example?
Well, because of your 100x return on this particular investment, the IRS...
Right, there's too much financial gain, and yeah. Yeah, I think in that scenario, again, you go back to when the investment was made, and when the investment was made, the primary intent was not to have that excess financial gain. It really was that charitable purpose, and still may be. It just happened to be that the activity of that PRI has been so successful that the return is better than expected, which is okay. It just can't be the primary reason for entering into that investment.
And that's why the documentation up front is so important.
Exactly.
When you enter into a PRI. Yeah.
Yes.
Let's move on to the next question. Can a PRI trigger the excise tax on jeopardizing investments if the foundation pays the PRIs out on top of the 5% required payout?
Oh, good question. I don't know if I've ever been asked this before. My initial response is, remember the table we went through where PRIs are not subject to the jeopardizing investments regulations under the Internal Revenue Code. So my initial answer would be no. You would still have to consider it for any of your corpus investing that you're doing. But again, you go back to the time in which you entered into the investment. But my answer would be no, just on the face of the question, because the jeopardizing investments regulations don't apply to PRIs. Because again, we go back to they're charitable in nature.
Okay, let's move on to the next question. Do you recommend loan loss reserves for program-related investments?
Good. Another good. Yeah, go ahead, Sarah.
And then I'd actually like to hear what Wendy has to say. So for our portfolio of program-related investments, we always have this question about, are you taking reserves against it? And my answer is no. I hold all my PRIs, which are debt. I have one equity PRI, but I hold them all at debt at cost. And I do sort of a light interpretation of the impairment test every year to make sure that I don't have a bunch of extended pretend type of PRIs in my portfolio. But if I believe that I can get my principal back on those, I'm not going to impair them. And from a materiality threshold, I'm comparing my PRI portfolio to the entire portfolio, and it just isn't material. So that is how I've left it with the auditors. I'd be interested in hearing what Wendy's perspective on that is. And I know there's a lot of people who have different interpretations of that.
Yes, and then, I will preface this with, I'm not an auditor, I'm a tax person. So to give you a real good answer, I'd want to follow up with our audit partner. But my experience with the private foundations that we work with, where I am looking at the financial statements as part of doing the tax work, I would agree with what Sayer has just said. We typically, again, first of all, they don't typically tend to be material, the program-related investments, if you will, to the investments as a whole. So usually I don't even know that there's much time spent on analyzing them. And the other thing I would add, which again brings my tax knowledge in a little bit, is we talked about the PRI agreements earlier in the presentation. And I have gotten asked questions before about, well, do we really need to have an agreement? Because even though we're going to do it as a loan, we really aren't going to be too sticky about them paying it back. And usually my response has been, if you're entering into a PRI that you are saying, for all intents and purposes, is a loan receivable, that's how you're putting it on your balance sheet, there is intent to pay that back. You definitely need to have an agreement because that's part of entering into a PRI, that's part of the requirements. But again, there's also that intent that it's going to be paid back. And at that point in time, I don't know that you go into it believing that they can't pay it back or won't pay it back, or you're not going to require them to pay that back. So to me, it almost seems contradictory if you were to automatically put loan loss reserves on those where they're truly done as loan receivables or note receivables, because you're really contradicting the intent is that it will be paid back. It's a different form than a grant, because otherwise you'd just be giving them a grant.
Okay, I think we have time for one more question, and because we only have a couple of minutes left. But I did want to comment that we have a great number of questions that have come in that we will answer offline, and some of those relate to community foundations or public charities. One asking that we do this again from that perspective, so we'll keep that in mind. So the last question that we have before we close out is there a rule of thumb for when to get tax rulings? to support if an investment is a PRI. Is that something that you do, Sayer? Do you get have you gotten tax rulings before?
Yeah, we try to keep the lawyers in business. Honestly, I guess I can be cynical about it. We've done enough PRIs now that we have a feel for it. As a person from who actually has to prepare and sign the tax return, I have to be comfortable that it qualifies, but I think that the qualifications for a PRI are pretty straightforward. And so if we get into some really bizarre transactions, I might push back. But it's all about at the outset. So whether or not it's a PRI is determined at the time that the approval is made. And then going forward, it's either a PRI or it's not a PRI. It can't change after the fact. And so related to rulings, we will if something's a little bit different. And also, this is sort of a shout out to Mission Investors Exchange. Most everybody has done. There's a lot of people who have done a lot of different transactions. So you can query back to Mission Investors Exchange to find other people who have done a similar transaction and maybe be able to leverage their expertise or maybe even their legal opinions. Not saying that you shouldn't do your own diligence, but there's a lot of that information already out there.
Yeah, I've advanced the slides to the additional resources and do want to affirm that we will take all the questions that you've submitted and attempt to provide an answer for you offline. We may even be able to distribute some of those answers as a follow-up after the evaluation. One of the things that I wanted to point out is that there are resources, and thanks, Sayer, on our website at Mission Investors Exchange and on the websites at Meyer Memorial Trust and Moss Adams. And I encourage you to use the resources that are available there. There are a lot of open resources on all of those sites, including free guides, articles, blog posts, links. There are templates like Sayer mentioned, and we have a mission investing database of investments that have been made. And I encourage you to contact us in order to help us to gauge the progression of mission investing in the aggregate by submitting your data for our database. The other thing is educational events. So we do have webinars routinely, and Moss Adams does these very routinely in general on this platform. But we have Mission Investing Institutes for those wishing to have a fuller perspective, especially about the program side of mission investing, as well as more about the financial aspects. And for us, those will take place in Chicago in May and in Atlanta this fall. So I want to take this opportunity to thank our speakers and to help you to know how to connect with us in the future, and our colleagues here at Philanthropy Northwest, those at Meyer Memorial Trust, from us here at Mission Investors Exchange, and particularly from Moss Adams, from Pam Amado Demayes. Sorry, Pam. And so I'm going to turn it over to Pam to give you a couple of reminders. And again, I want to thank our speakers, Wendy and Sayer, and wish you all a good day. And I'll turn it over here to Pam.
Thanks, Melanie, Wendy, and Sayer. Just as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet, which you can find in the icon that looks like a file folder of the webcast console. Now, if you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you should see a download icon in the bottom right-hand corner of the widget window, and you should be able to download a PDF copy of your CPE certificate. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. And if you have any issues, no worries. We will also be sure to email a PDF copy as well. Also, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you again for joining us.